companies play a crucial role in economic development by creating employment, encouraging investment, and supporting innovation. A company is a legally recognized business organization formed under statutory law. It exists independently from its owner and is treated as separate legal entity. Some key features of company include separate legal entity, limited liability of shareholders, perpetual succession, and the ability to own assets, borrow money, or sue or to be sued. In India, companies are governed by the Indian Companies Act 2013, which is the primary corporate law. This act regulates incorporation, capital structure, management, audit, disclosure, and corporate governance. It also introduces major reforms like one person company, mandatory CSR provisions, and independent directors with the objective of transparency, accountability, and investor protection. Under the Companies Act, companies are broadly classified into three main types. A private limited company requires minimum of 2 members and 2 directors and cannot invite public to subscribe its shares. A public limited company requires at least 7 members and 3 directors and can raise funds from the public through stock exchanges. A one person company or OPC is formed with a single shareholder and a nominee and has lower compliance required, making it suitable for the professional and small enterprises. Corporate formation refers to the legal creation of company through registration with the Registrar of Company or ROC. Formation is necessary because it gives legal recognition to the business, provides limited liability protection to the owners, improving credibility with the banks and investors, and is mandatory for raising institutional and venture capital. It also ensures continuity of business when ownership changes. The incorporation process under the Companies Act is completed in four broad stages. First is the preliminary stage where the company type is decided, DIN and DSC are obtained. The name is reserved through SPICE. Second is the application stage where the incorporation forms, MOA, AOA and the required documents are filled. Third comes the ROC scrutiny, where the compliance with legal provisions are verified. Finally, the certificate of incorporation is issued, along with the incorporation identification number, marking the legal birth of company. The Companies Act prescribes different formations required for different types of companies. A private limited company requires at least 2 members and 2 directors, restricts transfer of share and does not allow public issue of share. It has moderate compliance requirements and commonly used for startups. A public limited company requires a minimum of 7 members and 3 directors, allow free transfer of share, and can invite the public to subscribe. It is subject to higher compliance and disclosure norms. And OPC is formed with 1 member and 1 director, requires a nominee, does not allow public issue of shares, and has the lowest compliance burden. Corporate governance refers to the framework of rules, systems, and control through which a company is directed and controlled. It is essential to protect shareholders' interests, prevent fraud, ensure financial transparency, and improve board accountability. For listed companies, corporate governance is mandatory. Strong governance directly impacts a fundraising by attracting banks, venture capitalists, and foreign investors, improving credit rating and enhancing IPO valuation. A private limited company raises funds primarily through private sources. For example, Boat started with bootstrapping and later raised venture capital and private equity funding from institutional investors. Private companies typically use private placement, venture capital, and private equity, but they cannot raise funds from the general public. A public company has access to public capital markets. For example, IRCTC operates as a listed company and raised capital through an IPO approximately of rupees 645 crores. Public fundraising provides access to retail and institutional investors, liquidity of shares, higher transparency, and ability to raise funds repeatedly. An OPC has limited fundraising options. It mainly depends on the owner's capital and bank finance, such as MSME loans, Mundra loans, SIDBI refinance, and the NBFC working capital facilities. OPCs cannot issue shares to the public and can usually convert into private limited companies when they require equity funding for the growth. In terms of funding flexibilities, OPCs has the lowest access, relying mainly on owners' capital and debt. Private limited companies has moderate access through angels and venture capitalists, and also private equity. Public companies enjoy the highest flexibility through IPOs, FPOs, and institutional and retail investors. To conclude, incorporation provides legal structure, corporate governance builds investor confidence, and the access to capital determines the scale of business growth. Under company law, public companies enjoy the maximum fundraising capabilities.